Welcome to Module 5, Section 2, where I will take some time and explain the different sectors that make up the S&P 500. When we look at something such as the S&P 500 that has 505 stocks currently, we can get a bit overwhelmed. What do those 505 stocks mean? Can we break them down into categories? Well, yes, we can, and these are called sectors. And what Standard & Poor's has done in conjunction with other companies is they've developed 11 different categories or sectors that all stocks can be broken down into. So the S&P 500 or the SPX is divided into 11 different sectors based on their primary business activities. A company such as General Electric, they not only build light bulbs, but they also build airplane engines. So some of these big companies do lots of different things. What they've tried to do is define a company based on its primary activity. Sectors can be further divided into 24 different industry groups. Now, there are other ways to divide these, and you come up with hundreds of industry groups. The video that comes right after this talks about industry groups, and I just break them down into 24. Sectors were created by Standard & Poor's, or S&P, and Morgan Stanley Capital International, MSCI. They work together to come up with these sectors. It's not as simple and as straightforward as you would think. Sectors are also known as the Global Industry Classification Standard, or GICS. So you may run across that acronym from time to time. These are the different sectors that they break down all of the stocks into. There used to be 9 for a while, and then I added a 10th one. And then there were other sectors that nobody really paid attention to. A few years ago, things were revamped, and it's much more helpful for us to gain insight as to what is going on. So I won't read through the names and the symbols right here, because all of these not only are an index that you can follow, I like to follow the ETFs, because with these ETFs comes volume. And we not only like to look at price, we like to look at volume as well to gain more insight. So let's go through these 11 different sectors as they are defined. And these are in no particular order. I got this from the SP Global website. The very first sector is the communication services. These contain companies that provide content, such as Facebook or Twitter, information, advertising, entertainment, news, social media, and different data that is delivered on networks primarily through the internet or broadband, cellular, cable, and landlines. So anytime we're communicating back and forth, whether it's by voice, video, or we're sending data back and forth, that is a communication services company. The second category is consumer discretion. This sector contains businesses that are more sensitive to economic cycles, including makers of automobiles. Do we really need that second car right now? Or things are going really well. Let's buy that cabin that we always wanted to get. Household durable goods. Do we want to get a new washing machine right now? Leisure equipment. Okay, let's put in a swimming pool. Let's buy the workout equipment and set up a gym in our house. And textiles and apparel. When things get rough, do you go out and buy a lot of new clothes? Not necessarily. When things are going well, that might be when you splurge and buy some new clothes. This also covers things such as hotels, restaurants, and other leisure activities, as well as retailing. Things that are nice to have and that make the quality of our life better, but we don't necessarily need them. So we're discretionary about them. Sometimes we can afford to buy those things. Other times we can't afford to buy those things. The third area are consumer staples. These are things that people have to have no matter what is happening in the economy. They're less sensitive to economic cycles, and this includes manufacturers and distributors of food. Yes, we need food no matter what's happening. Beverages, tobacco is included in that, producers of non-durable household goods, and different personal products, soap, shampoo, toothpaste. This also includes food and drug retailers, since these are things that people have to have. The fourth area is energy. This covers different companies that are involved in the exploration and production, refining, marketing, and storage, as well as transportation of oil and gas, as well as coal and consumable fuels. This also includes companies that offer oil and gas equipment and services. We need oil and gas for our cars, for our homes, for our businesses, so they broke this off and created a separate sector just for energy. Continuing on with these sectors, number 5 are the financials. This includes banks and different thrift organizations such as savings and loans or credit unions, as well as providers of diversified, meaning they give a lot of different financial services, specialized finance, consumer finance, asset management, and custody of securities. This would be like your broker, investment banking and brokerage services, capital markets, financial exchanges like the NYSE or the NASDAQ, the different data and analytics, insurance underwriters and brokers, and mortgages, as well as REITs, real estate investment trusts. When you're dealing with a lot of money or some kind of financial resources of some kind, that will be put into the financial sector. Then we have healthcare. This includes healthcare providers that also provide services, different companies that manufacture and distribute healthcare equipment as well as supplies, and the different healthcare technology companies. This also includes pharmaceutical and biotech companies. Then the industrials, these are the more boring products, but we have to have them. This includes manufacturers and distributors of different capital goods, such as building products, electrical equipment, machinery, aerospace, and defense. Boeing would be included in that. This includes providers of commercial services, such as construction and engineering, printing, environmental services, human resource services, research and consulting services, as well as transportation services. Then we have information technology, and a lot of times we just refer to this as IT. This covers companies that offer software as well as information technology, consulting, and data processing, excluding internet services and home entertainment. They put that into another category. But it does include manufacturers and distributors of technology hardware and equipment, such as communications equipment, gotta have your phone, cell phones, computers, electronic equipment, and semiconductors. Then moving on to number 9, we have the materials. This includes companies that manufacture chemicals, construction materials, glass, paper, forest products, and related packaging products, as well as metals, minerals, and mining companies. And this also includes steel producers. Number 10 is real estate. This includes companies that offer real estate management and development activities, as well as equity real estate investment trusts, or REITs, including diversified, industrial, hotel and resort, office, healthcare, residential, rental, and specialized REITs, but excluding mortgage REITs. That's off more into the financials category because they're tradable instruments. And then the 11th sector are utilities. This includes utility companies that provide electricity, gas, and water utilities. This also includes independent power producers and energy traders and companies that generate and distribute electricity using renewable resources. So looking at all 11 of these different sectors, we get a pretty good representation of all the different areas of the U.S. economy. The source is right here below. I found this at SP Global. I just took all this information right from their website. I'll also include this in the description right below this video. So the next area I'm going to talk about is just to give you some charts to look at. I don't have any studies on these charts. There's no moving averages or oscillators. There's really no analysis. I just wanted to show you a bar chart going back 2 years, the bar chart on the top and the volume on the bottom. I'm really not doing any analysis. This just gives you an idea of how these different sectors have performed over the last 2 years, including through the COVID plunge. The first one is technology, and these are not in any particular order. But technology really did well during the whole lockdown phase. Then we have communication, which also did well. All of these sectors have done well. And this is what we do during the day. If I make a blog post or when I do my daily analysis and commentary, I may say 8 out of the 11 sectors were positive, and these were the 3 that were not positive. Okay, this is something that we need to watch out for. We not only break these down into categories, we analyze them and see how they interact with each other. And I go into a lot more detail of how we use this and how we can analyze this to help us understand where things are at in the economic cycle. We also look at healthcare, which again has done well after the COVID plunge. A lot of these charts at the time I'm recording this video, some of them are reaching all-time highs. So this gives you a little bit to compare with because some of them are struggling a little bit. Here is consumer discretionary, the things that people don't have to have, but they've been holding up quite well with the stimulus checks and people having a lot of extra time on their hands and maybe using some of their savings. They were able to splurge and get some things that if we were having more difficult economic times, they may not be able to get. Here are the staples, the things that you have to have. And some people, this is all they invest in. They like the soap and the toothpaste and the shampoo companies because they feel that they'll always be in need. There's some real solid logic behind that. However, there are other times when other sectors will outperform this sector. And some people really enjoy that. They look at the sectors all the time and they say, okay, I'm going to move everything out of one sector into another sector. It doesn't mean the sector that you choose will go down. It's different sectors behave differently during the whole economic cycle. Then you have the materials, which is not currently at an all-time high, but is still doing quite well. And then the utilities. If you want to match up financial instruments with each other, what I do is I look at utilities and interest rates at the same time. Some people, including myself, also add the utilities index to what we call Dow theory. We look at the Dow Jones Industrial Average. We also look at the transports. Those are the main 2 indexes. But then what I personally do is I'll add the utilities index. I look at them every day, and if something is happening, I report on that in my videos. Then we have real estate, which has done really well. Housing prices are just going sky high. So not only do we see a lot of stimulus being put into the economy right now, we see home prices really going up drastically. Some people are thinking that that looks eerily like the year 2000 when we had the dot-com boom and bust. They're seeing that more in the cryptocurrency market. And then people are also seeing a problem in the real estate market where we had the whole housing meltdown that led to the financial crisis. Other people say, no, things are different now. This time it will be different. And the way money is being dispersed, the way it's being used, that's different now than it was back in 2007 and 2008. And as far as cryptocurrencies are concerned, well, that's just a whole new thing. And that's the wave of the future anyway. So you can make a case for either side. Then we have the industrials, which again have held up pretty well over the last year and a half after the COVID plunge. And then the financials. This ETF that you're looking at right here is one of the more popular ETFs. People really like to trade in this. And then there's also the energy sector, where it's not at an all-time high, way over on the right-hand side. As gas prices and oil prices have gone up, the energy has really gone up, but we're starting to see that fall back a little bit now. So again, I just wanted to explain the different types of sectors that are available to you in the markets. I look at these from an analytical standpoint. Some people use these from an investment standpoint, and they like to do what's called sector rotation. They'll get out of one sector and into another sector to be more offensive. They're going to take more risk. And at other times, they'll become more defensive because they think we're coming on rough times. So there's a real sound philosophy behind using sector rotation is what we call that. I don't rely on that heavily. Just as an example, okay, we're seeing weakness in discretionaries, and we're seeing staples really start to go up. People aren't spending as much on what they want. They're spending money on things that they need, and that's usually more defensive. That means we're having some economic problems. That's just one example that I go through in my course. So if you are more interested in that and learning more about sector rotation and different strategies that you can implement, consider looking into the classes that I teach. This concludes Module 5, Section 2, and I will pick up with things again in Section 3.